Coach Julien here. In this video, I'm going to talk about the top investment mistakes I did when I started investing. I started about 30 years ago with my dad, and we were totally clueless. We invested during the tech bubble, and yeah, we made some money. We're lucky, but when the tech bubble burst, we lost a lot of money. And instead of giving up, I looked at what mistakes that I made. For those of you who are do-it-yourself investors, go through this, and hopefully you'll learn from this. You don't have to repeat the same mistakes and waste time and money. And so enjoy, and let me know your comments. Hi, I'm Julien, Regoli, CPA, CMA. You're a finance coach. My objective is to simplify money concepts such as saving money, investing money. So my channel is about that. I simplify saving and investing concepts so that you can do it yourself confidently. If this is the kind of topic you like and are interested in, well, sign up to my channel, hit the bell button, and you'll be notified whenever I upload new content. So here are my top mistakes. Number one, waiting too long. Don't wait, because when it comes to investing, time is money. Time is on your side. So don't delay. Don't wait for the promotion. Don't wait for events to happen. Just start doing it right away. The second mistake is not systemizing investing money. What that means is putting aside money on autopilot. For example, let's say you receive a paycheck every 2 weeks on Thursday. Well, that same Thursday, every 2 weeks, you should have a system which transfers money from your checking account to your investing account. It's done automatically. This is easy to set up with your brokerage account, with your bank. Let's say your paycheck is $2,000 and you save $500 out of that. Then you gotta make sure that you live on that $1,500. It's called paying yourself first. It's called investing and saving on autopilot. Call it what you want, but it's a very, very important concept to implement. Mistake number three is ignoring taxes. In Canada, we pay a lot of taxes. We're a highly taxed country. You got to plan so you don't pay more taxes than you need to. It doesn't mean tax avoidance or breaking law. What it means is understanding the tools and the programs out there that the government has at your disposition to minimize the amount of taxes. You need to put your savings and investments into registered accounts, and there are three main ones: the RRSP that turns into a RIF at retirement, the TFSA, the tax-free savings account, and then there's the RESP if you have any kids. Whenever you make investment income in these, they're not taxed, at least they're not taxed right away in the case of the RSP. So make sure to take advantage of these programs because they're there to help you save money. And believe me, they are amazing programs that will allow you to fast track to becoming financially independent. I have videos that talk about TFSAs, RRSPs, RESPs. I have multiple videos. Take a look at them. I'm going to flash them here in the video. The fourth mistake is not reinvesting your dividends, your interest, and your investment income. This is pretty critical because the money generated by your money needs to be reinvested. That's the compounded effect. So money, making money, making money, making money. It's like a snowball effect. Imagine this big snowball getting bigger and bigger as it rolls along. There's a video I did on DRIPs, dividend reinvestment programs. It's very easy to set up. It's zero cost. Mistake number five, taking money out before retirement. I have this line: once money crosses over to the saving and investment accounts, it never goes back. It's only one direction. It never goes back the other way. The only time it goes back the other way is at retirement. If you take money from your savings and from your investments, it's like borrowing from the future. That means delaying retirement. Never put your hand in the cookie jar. Once it crosses over to that other side, you can't touch it. It's there, leave it there until retirement. I'd like to understand from you, what is the worst mistake that you've done as an investor? Share it, post it in the comments, send me a note. Mistake number six ignoring costs. You need to choose a platform. If you're trading, doing the trades by yourself, there are platforms out there that are commission free, so you can take a look at those. The other thing is you want to take a look at ETFs versus mutual funds. ETFs are exchange traded funds. They're different than mutual funds. They're better, in my opinion. They're cheaper, more liquid, and they're more transparent. I have a video that I'm going to flash up here that talks about the difference between ETFs and mutual funds and why ETFs are better. One of the main differences is that ETFs are cheaper. They cost a fraction of mutual funds. You need to look at the management expense ratio. Cost is very, very important long term. 1 to 2% saving in cost per year can make a significant impact over a span of 20, 25, 30 years. So do not ignore that. 1 to 1.5%, 2% saving. Mistake number 7 is not doing your research. If you're going to be investing in single stocks, or you're going to be in some piece of real estate with investment income, if you're going to be buying a business, you need to do your research. You need to do some analysis to understand what you're buying, to understand the fundamentals of your investment. In the example of stocks, before buying a share, you got to look at the company behind that share. So, what are they making? What kind of product are they making? Is it something that has potential? What do the revenues look like? Are the revenues looking like this, or are the revenues looking like this? How are they trending? How are they generating any cash? Is it profitable? Are the profits going up? Are the profits going down? Are the margins flat? Are the margins going up? Are the margins going down? How's the management? Do they have a good reputation? What does the balance sheet look like? Do they have a lot of debt? Are they buying back shares? All kinds of questions, all kinds of things that you need to look at. A lot of people take the lazy way. They look at, they're on Facebook, they spot a tip on a stock and they buy it, saying, well, that guy had a good recommendation last time and the stock did well, and he's recommending this now, and so I'm going to follow since the last one did well. I mean, you got to base your decisions on a little more than, hearsay and stock tips. So be very careful, and I'm going to talk to you about a little later on. If you don't want to do that on all that analysis, that's all right. There are ways to invest without drilling down in each company and doing that thorough analysis and getting that headache. There are ways around it. So bear with me. I'm going to talk about it in a second. One mistake I did was to chase high dividend investments, high dividend stocks, just to get killed after on the share price. So, oh wow, 12%. Buy that stock and the share price tanked, and took years for that to recuperate. If you're looking for a dividend investment, take a look at the historical trend of the business's cash flow from operations, because cash flow from operations is what they use to pay dividends. If there are no cash flow from operations, then the business does not generate enough cash to pay dividends, and so the dividends will be inconsistent. So you got to spot really consistent cash flow from operations in order to make sure that dividend payout is possible. Also, look at the historical trend on dividend payments. Have they always increased the dividends? Have dividends been stable? Are they decreasing the amount of dividends? What does the historical trend look like when it comes to dividend distribution? But always look at the two together. Look at the cash flow from operations. Is a business generating cash flow consistently? And does management have a dividend policy of distributing on a regular basis? And then that's a good investment if it's for dividends. So make sure to do your analysis to validate your investment intentions. Mistake number 8. Putting too much in a single stock or in a single sector. When the lockdown happened in early 2020, that was a real eye-opener. That really exposed portfolios that were overweight in certain sectors. So someone who had too much in the airline industry or too much in the travel and tourism industry, even the restaurant businesses, their portfolios suffered tremendously. And I had a lot in a company called MTY Food Group. Love that stock, still love it. That stock got killed in early 2020. Stock has bounced back up, but let me tell you, it really exposed my portfolio. So be careful. Don't overweight on a given stock or a given sector. My recommendation is don't exceed 10% on a single stock and don't exceed 20% in a single sector. If you're unsure about sectors and stocks, there's always the possibility of index investing. You get an exchange traded fund, an ETF, on an index like the S&P 500, like the TSX, like the NASDAQ, or the Dow Jones. Buying an S&P 500 ETF is like buying 500 shares. So you're super diversified. You're not betting on a sector or a single company. You're investing in an economy, the American economy. So that's much wider than a sector investment or a company-specific investment. Mistake number 9, this is something that I hear a lot. It's a mistake that new investors tend to make. They tend to think that penny stocks are cheap compared to, like, for example, Tesla is over $1,000 US. Okay, I'm going to buy a penny stock because it has more upside. You know, the price of a stock has nothing to do with whether it's overvalued or undervalued. I'll give you an example. If you have a company that's worth $100,000 and it has 100,000 shares, each share is worth $1. If that same company only had a float of 10,000 shares, then each share would be worth $10. Now, scenario 1 is at $1. Scenario 2 is at $10. Does that mean scenario 1 company is cheaper than the second scenario's company? No, not at all. The company's worth $100,000. It's just that one company has more shares in float, the other doesn't. Again, the share price doesn't tell you if the stock is overvalued or undervalued. There are metrics for that, like the price earnings ratio, like revenue trend, things like that, like the market capitalization, like the balance sheet value. There are other ways to validate and evaluate if the company is undervalued or overvalued. If you don't understand that concept, feel free to book some time with me. There's a link to my Calendly in the description of the video. Hit that and I'll give you free 30 minutes. But make sure to understand that concept. Please don't think that penny stocks are cheap. Number 10, not knowing yourself as an investor. And you're going to tell me, well, I don't know myself. I'm new at this. I don't know what my style is. Well, I'll give you a couple of things to think about. One is risk. You'll quickly understand where you are in relation to risk. If you tend to not sleep at night because the stock market corrected 1%, 2%, after some time, if you notice that you're very, very anxious when the stock market corrects, like it affects your mood, you're depressed, you don't talk to your friends and things that you're probably a risk-averse person. You have low tolerance for risk. So maybe you want to think about investing in things that are less volatile, less risky. Another thing is how much time you want to spend on managing your portfolio. Are you an active investor or are you going to be a passive investor? That will determine what kind of investments you make. If you're an active investor and you're interested in analyzing the companies behind the shares, you want to know about the management, you want to know about the competition, and you want to, really understand, then buying single stocks and buying ETFs in different sectors, that's probably okay for that kind of investor. If you're a passive investor, if let's say you want to buy something and then just forget about it, probably you want to be looking at an ETF that follows an index, or you have a selection of ETFs within a sector. So you'll hold like a handful of ETFs, and depending on how passive you are, at the end of the year, you say, okay, well, this has done well. I'm going to sell some of that and I'm going to buy some of this that's gone a little lower, and you readjust every 6 months or every year or every 2 years. If you're a passive investor, buy investments that don't require a bunch of analysis. An example is VOO. It's an ETF that follows the S&P 500. You're investing in the American economy. If you believe in the American economy, then you buy that and you just go to bed and you forget about it, and then you arrange with your bank to reinvest in that on a regular basis. There are strategies for active investors, passive investors, hybrid kind of investors, and so adapt your investments to your investment style. Mistake number 11 is not having a network. And what I mean by network is a few people that you can talk to bounce ideas with, to exchange, talk about money, talk about real estate, talk about stock market, talk about trends. If you're thinking about investing in a business, buying certain shares of a business, or buying some real estate, whether to get a mortgage, whether to pay down the debt, all those kinds of questions you can bounce off of some people around you. And these people should ideally be business people that can challenge you and say, well, did you think about this? Have you thought about that? And that'll help you develop as an investor and as a business person. You're just going to learn more and more and more by surrounding yourself with good business people, people who think and who are financially literate. So it's really important to have that sounding board and that network around you. So I hope this video was useful. If you found it useful, give it a thumbs up. Again, you can book some time with me by clicking on the link in the description of the video. The first 30 minutes are free. Don't forget to sign up to my channel and hit the bell button. You'll be notified whenever I upload new content. Guys, thanks for watching, and we'll see you real soon.